Ladies and gentlemen, good day and welcome to Prataap Snacks Limited's earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Shah from CDR India. Thank you, and over to you, sir.
Thank you, Stephen. Good evening, everyone, and thank you for joining us on Prataap Snacks Limited's Q2 H1 FY23 earnings conference call. We have with us Mr. Amit Kumar, Managing Director and CEO, and Mr. Sumit Sharma, CFO of the company. We will begin the call with a brief opening remarks from the management, following which we will open the forum for an interactive Q&A session. Before we begin this call, I would like to point out that certain statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I'd like to hand over the call to Mr. Amit Kumar for his opening remarks. Thank you, and over to you, sir.
Thank you. Good evening to all the participants, and thanks for joining our Q2 and H1 FY23 earnings conference call. I trust all of you have gone through our presentation, which was shared with you earlier. I am pleased to share that we have delivered a strong revenue growth of 23% during the quarter and 29% during H1 FY23. This robust revenue growth was due to rise in volumes driven by an uptick in consumption and demand across most product categories and key geographies. We have seen volumes increasing all over markets, with several product categories witnessing growth about 25% year-on-year. Growth for Awadh has been 25% year-on-year, which is in line with Yellow Diamond products, indicating the broad-based nature of revenue growth. While economic activity continues to rebound strongly after the disruption of last 2 years, we have taken several steps to capitalize on the anticipated return of demand. The continuous addition of new retail touchpoints and enhancing of the distribution footprint in focus markets has added to our reach. The shift towards direct distribution and the compression of the layers to our distribution network has enabled us to strengthen our entire distribution platform. We have added many vehicles to our fleet in the last 6 months, along with above-mentioned initiatives have resulted in better coverage of territories, leading to higher volumes. Coming to margin performance, where there is a further good news, we have witnessed softening in the prices of key raw materials like palm oil and also in packing material. This reversal in input prices and our cost-cutting initiatives undertaken in previous quarters resulted in a better margin performance. EBITDA this quarter has been 4.8% compared to 0.5% in Q1 23. During the quarter, our subsidiary Awadh has delivered an EBITDA margin of 8.7%, surpassing the margin performance of the parent company. As you can see from our slide 19 of our presentation, the average EBITDA margin for a period of 5 years during FY16 to 20 was 6.9%. From end 9-20, due to the COVID disruption and the sharp rise in commodity prices, primarily palm oil, but also in packaging cost, fuel, as well as corrugated boxes, we witnessed immense pressure on margin, which dropped to low single digits. In the last quarter, as palm oil prices were at the peak, we reported a negative EBITDA margin. To counter this margin pressure, we restructured our distribution model to eliminate the super stockist layer, as shared on slide 11. With the arrangement, we are able to save around 3% margin due to lower distribution, primarily margin from one layer of distribution and onward freight. Further, this has provided us some more controls and understanding of the consumption patterns for products. We also implemented process improvements by introducing automation, pruning of our product portfolio to remove less popular products, and by tweaking pack sizes to enable better realization. Further, we have actively sought to procure key raw materials under longer-term contracts to lock in attractive prices whenever possible. The result of these initiatives is that there has been a structural improvement in the sustainable EBITDA margin that the business can deliver. The commodity cycle has only just started to ease out, and we anticipate further positive impact on EBITDA margin from reducing input prices. We are confident that our new cost structure in place we can target double-digit EBITDA margin in the coming years. We believe we can deliver a double-digit margin despite prevailing raw material prices, which remain substantially higher than the pre-COVID level. One key development during the quarter was the addition of manufacturing facility in Jammu region. This facility will help us enhance our reach in the northern market. We have partially completed the purchase of land there, and the proposed facility will be second largest in our manufacturing grid after Indore. The proposed investment in the facility will qualify as committed investment as per the approval of PLI scheme. The addition of the facility is in line with our goal of deepening our footprint as a pan-India player. In this regard, I would like to bring your attention to slide 6, which shows the evolution of our company. In less than 2 decades, we have emerged as a pan-India player with a diverse product portfolio with operations at scale. A large part of the growth has come in the last 8 years, where we have seen increase in products presence and facilities, allowing us to scale revenues over 3x in these 8 years, which include 2 years of COVID-induced disruption. We believe we are differentiated from many other snack food players who are largely regional in their focus. All of this has been undertaken in a short span of time compared to other companies, some of which are 4 to 5 decades old. In that backdrop, let me now quickly take you through our financial performance during the period under review. In Q2 FY23, revenue grew by 23%, came in at 45.72 crores. EBITDA for the second quarter stood at 22 crores with margin steadily at 4.8%. EBITDA during H123 stood at 20 crores. PAT during the quarter stood at 42 crores, while it stood at rupees minus 1.5 million in H123. To summarize, we have delivered a strong performance during the quarter and are optimistic of delivering better performance in the quarters to come. With the structural changes made in distribution model and other improvements measures coupled with reversal in commodity prices, we are confident of delivering better margins for the full year. On that note, I conclude my remarks and we can open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Hello. Hello.
Yes, Mr. Jain, please proceed with your question.
Thanks for the opportunity and congratulations, Amit ji and team for a wonderful performance on all fronts, including balanced improvement. Sir, a couple of questions. One, you have had a fantastic sales growth in this quarter. So how do we expect this momentum to continue in coming quarters? And what has helped us to deliver this growth? And typically, how do we look at the next 2 quarters going ahead, next 3-4 quarters going ahead in terms of the sales momentum? That is my question number 1.
Okay. So on the growth front, if you see, we grew by more than 30% in the last quarter and 23% this quarter. The last quarter, but definitely we had a little bit base effect of the COVID times. But with the deeper distribution model and starting new areas and with the new product portfolio, we think we can deliver the growth what we did in Q2. The minimum basically what we committed is 15% probably, but the growth can be more than that. If you see our distribution structure, we were at 1.8 million outlets and currently we are at almost at 2 million outlets. With direct distribution going up and getting entry into A and B class outlets with 10 and 20 rupees product, we are very confident of this kind of growth in probably next 2 to 3 years time.
Sure. So how do we look at the larger pack and the namkeen percentage moving ahead as a proportion of total sales?
Namkeen, yeah, so I think there is almost more than 35% growth in the higher value packs in the last quarter. And we think it can further grow substantially from here, but it will take time. It's a slow process. It can't be done in a day or 2. It will take some time, but it's definitely growing. Namkeen as a category also, we have grown quite a bit. Compared to last year, probably the overall sales percentage of namkeen has increased by more than 3 to 4%. in overall sales volume.
So, sir, for us, the margins in Namkeen and also not just the gross margins and EBITDA margins, both, how do they pan out for us in Namkeen?
I think they are a little bit on the lower side, but if you see combination of all the products, all MRPs, we are confident with the softening of raw material prices, which has already happened and already in the process. We are targeting double-digit EBITDA probably next 2 to 3 quarters time.
Sure. Last two things, sir. One is on the other expenses side. We have seen a sharp jump in the other expense in this quarter. Typically, if I see the numbers for almost last 10 to 12 quarters, including before COVID also, the other expenses for this quarter seems to be on the highest side. Any particular one-off kind of expenses or any particular expenses which we have incurred?
Yeah. Hi, Rahul. This is Sumit.
Hi.
So there is some restructuring in the sales force settlement. We have a large sales force which is largely on the role of the distributors. And traditionally, we used to settle the cost of those SRs through credit notes to our distributors. And when we settle any credit note, that is netted off from the revenue. Now, from May onward, we have restructured this, and most of the sales representatives have been transferred to the third-party payroll. Now, in this case, we are directly settling the salary of those sales representatives. And now, with this arrangement, the cost of those sales representatives is a part of other expenses. So earlier, that used to be netted off from the revenue. Now, that is a part of my other expenses. The quantum of that SR cost is roughly around 1.3% of the revenue.
Okay.
So that much difference is because of the restructuring in the sales force, payment settlement mode. I think barring this, the most of the items are in line. There is some pressure on the fuel cost, some increase in the logistic cost, not very significant, and there is a minor increase on the contract labor cost because of the minimum wage revision.
So this typically, the other expenses will remain somewhere around this number.
Yes.
And sir, lastly
So
on the...
percentage that should remain.
Sure, sorry. Go ahead, Sumitji.
Yeah, thank you. So in terms of percentage, that should largely remain in this range because most of the items are variable in nature. So that will be in line with the growth in revenue and production.
And sir, with the completion of rainfall and also some extended rainfall in some particular areas, how do we look at the availability of potato and the prices of potato going ahead? Any concerns or any positive feelers over there?
So I don't think there is any concern on the quantity or availability of the potato for the going year ahead. The only issue probably the crop might get delayed by 7 to 8 days. Earlier probably we used to get around 27th or 28th of November, the no crop used to come. It might get delayed by another 7 days.
Sure. So we don't see any issues on the availability and the pricing part of it.
Yeah, not as of today.
Sure. Thank you so much, sir. In case of further questions, I'll come back and wish you all the best.
Thank you.
Thank you.
Thank you, Rahul.
A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, Amit ji and Sumit ji. Congratulations for a very good set of numbers. So my first question is this: our aspiration to go to double-digit margins. That is exclusive of the PLI benefits, right? This is operational EBITDA that we are talking about.
Yeah, certainly that is exclusive of PLI scheme, but we believe that with PLI scheme we should be able to clock double-digit margin very soon because in Q2 we did not get the entire benefit of the reversal in the raw material pricing because we always have a basket and there are some short-term contracts. So the entire benefit of the reversal in commodity pricing will flow maybe in 1 or 2 quarters. But in the long run, certainly we are aspiring for a double-digit margin even without PLI scheme.
Okay, got it. A second question is, sir, this raw material prices have softened across the board, and how do you see the actions of the peer group in terms of pricing? Are they kind of willing to pass on this price reduction and gain market share vis-a-vis getting better margins? And what is the impact of that on our strategy? If you can talk a bit about that.
I think as of date, there is very little impact as far as the competitor concern is concerned in this regard. But going forward, if the prices further drops, there might be some increase in weight for the consumers, and probably we will also be able to do with them. So no major margin transfer from here to that level, unless and until there is a steep fall in raw material pricing.
Okay, got it, sir. And sir, with whatever capex that we have planned for PLI benefit and our existing capacity put together, what is the revenue number that we can do? Will we be able to do 2,800 crore after the capex is done?
So including the proposed capex, what we are planning in Jammu and some other location, we should be able to clock at least 2,600 crore to 2,700 crore revenue with assuming the full utilization.
Okay. And also, last question from my side. So we are focusing on larger packs, and traditionally we have not been there. As large part of our revenue come from a 5 rupee pack. So and hence our focus was Cat C, Cat D outlets. So how easy or difficult it is to get into Cat A and B outlet with only larger packs where we did not have any presence beforehand?
I think we started this activity 6 months back, and the response profile has been extremely good. We have appointed different set of sales officers and sales representatives who can go on these outlets, and the results are encouraging.
Okay, so there is a separate sales team looking at Cat A, Cat B stores.
In few areas, we have different set of sales representatives and sales officers who are going into the market.
Okay, got it. I have more questions. I'll come back in it. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Kunal Patel from Equilegence Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congratulations on good set of numbers. So my first question is regarding ad and marketing spend. So at what level do we see this as a percentage of revenue going ahead, given economy has returned back to normalcy now? And do we plan to hire any ambassadors for our products like we did in 2017-18?
If you see, basically we did the same activity in 2017-18 with Salman Bhai. And currently, last 2-3 years, because of COVID, we are just concentrating on kids advertisement that with our ring product. But going forward, definitely with the raw material pricing easing out and the margin improving and more coverage in the market, we definitely intend to have probably one good brand ambassador and do some branding activities in Q4 or coming Q1.
So would it be roughly around mid-single digit kind of number as a percentage of revenue that we are targeting?
I think the current set of numbers is around 1% is basically our advertisement cost. I think probably it can go by another 1 to 1.5% max.
Okay. So regarding Awadh, what kind of volume growth did we see in Awadh, and do we see more scope of margin improvement apart from the fact that raw material prices have gone down? So any other scope of margin improvement there?
You're talking about Awadh?
Yes.
Okay. So okay. So basically, definitely we have done a lot of changes in Awadh. Basically, we have changed the pack sizes and got some better machines to improve the yield also. and we think that could easily be a double-digit EBITDA number, but not much changes in the distribution structure there, because the distribution structure was already lean there.
Okay.
But the margin probably would be a little bit better than our parent company, Prataap Snacks, in our.
Okay. So you talked about bringing new machinery. So does that expand capacity for us?
Little bit, yeah. Getting
okay.
better packing machines, getting better extruders.
Okay. And what was the volume growth?
For us, I think the volume and the value growth are almost similar.
Yeah, because we consider number of packet as a volume, because the consumer buys the product as a packet, not in terms of grammages. So for us, it's all a transaction growth, volume growth.
Mm-hmm. Okay. Okay. So lastly, on the gross margin side, so we did roughly around 28% gross margin, and the raw material prices have started to come down. So what was the average raw material cost last quarter, and where do you see it stabilizing in this quarter or coming 2 quarters? And do we see low 30s gross margins over the next couple of quarters?
In our COGA, the key raw materials are basically the packaging material and the packaging laminates and palm oil. Palm oil for last quarter was roughly in the range of 124 rupees per kg to 126 rupees per kg.
Okay. And do you see that?
And that has.
Yeah. Sorry. Go ahead.
That has come down. That has come down further. So that was the average price, because we always have some short-term contracts of next 1 to 3 months time. Packaging material has also reduced a bit after the quarter 1. For the quarter 2, the average price was roughly around 211 to 213 rupees per kg.
Oh.
That has also reduced further.
Got it. So we see low 30s gross margins in coming 2 quarters, given where the prices are right now, raw material prices are right now.
Certainly, there will be the positive impact, which is still left.
Okay. Thank you so much, sir. I'll come back in the queue.
Thank you.
Thank you, sir.
A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Gaurav Agarwal, an individual investor. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, the double-digit EBITDA.
Can you take the phone off speaker, please?
Yes.
Is it better now?
Yes, sir. Please proceed.
Yeah.
Yes. Thank you, sir, for giving me the opportunity. Sir, the double-digit EBITDA margins that you talked about, so is there a possibility that we can see those kind of margins in FY24?
Yeah, certainly we are aspiring to have double-digit margin at FY24. Because over the period we have made a lot of changes. If I just take you through the journey, as Amit ji has also mentioned in his opening remark, that if we consider average period from FY16 to FY20, our EBITDA margin used to be in the range of 6.5 to 7.5%. The average for those 5 years was roughly around 6.9%. And during that period, the average palm oil price used to be in the range of say 55 to 65 rupees per kg. Now, with having pressure on the key raw material pricing, we have made many changes in our overall structure, including the direct distribution, changes in pack size and other process improvement measures. And because of those savings, even with the higher raw material pricing, even higher, more than 50% higher price in terms of palm oil, we can get to double-digit EBITDA margin.
Okay.
Certainly with this prevailing raw material price.
Sure. And these double digits will certainly have a scope to improve further, like in years beyond FY24. Like, they can move to mid double digits also. Is there a scope to do that, or we would be happy at 11-12% kind of EBITDA margins?
No, there is always scope to further improve. So scope never ends. So certainly there will be further scope for improvement.
Okay, sir. In your business, would 15% EBITDA margin be possible?
I won't comment on the exact number of 15%, but yeah, certainly there is a possibility for a slightly higher double-digit margin. Yeah.
Okay. And sir, lastly, on the inorganic side, do we want to acquire any brand which is on the healthy side of snacks, or anything which we are looking to acquire, any regional brand which we are looking to acquire at this point in time?
Not right now. Nothing in mind right now. Many people have approached us, many companies have approached us. We couldn't find the right fit. Not looking for anything as of today.
Okay. Okay. Thank you so much, sir, and all the best.
Thank you.
Thank you.
Thank you.
A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Meet Shah. Please go ahead. We are unable to hear you. May we request you to please unmute your audio from your end and please proceed with your question.
Hello, can you hear me now?
Yes, I can hear you. Please proceed.
I had a question regarding the Jammu facility. Which would be the key markets which you would cater from this?
So if you see in northern India, we are already strong in Haryana market, but the Punjab, Himachal, J&K, Uttaranchal market, we are not that good. I think we definitely target J&K, Himachal, Punjab and Uttaranchal market from there. Though we will have supplies to coming to Haryana and Delhi also, because the reverse logistics advantage is available in Jammu. So, but the key market what we are looking to targets are Himachal Pradesh, J&K, Uttaranchal and Punjab.
Sure, sir. That's it on my side.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Priyank Chheda from Standard Chartered Securities. Please go ahead.
Yeah. Hi. Thanks for the opportunity. So my question is regarding the grammage. What is the contribution from the 5 rupee pack? I think it was more than 90%, and we target to reduce that. What are the steps and the strategy that we want to deploy to reduce that segment of the grammage?
So firstly, basically, it used to be more than 90%. It is currently a little bit less than 90%. Secondly, we are targeting A and B class outlets with 10 and 20 rupees per pack. Thirdly, we are tying the higher packs of namkeen in the range of 20, 40, and 100. All these three things, activities put together, we definitely intend to bring this closer to 90% level to 75% in next 2 to 3 years' time.
Okay. And the second question is regarding the PLI scheme. So we would be getting that incentives from FY25. So I just wanted to understand the accounting part of it. Would it be that we would be accounting for the full sales and that additional 7.5% would directly flow into the EBITDA?
So the PLI scheme is available even from current year, and we have started recognizing it in our P&L account. That is part of our other operating income. The income is recognized on an accrual basis. So based on the full year estimate, we recognize for the quarter.
Okay, so that would be a part of other income or other operating income. And what was that income? What was that percentage of it?
It is for this quarter 2, the exact amount is roughly around 3.6 crore.
Okay. Okay. All right. Thanks. That's all from my side.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir.
Yeah, I'm just a bit new to your company. Just needed a little more details regarding Prataap Snacks. We have gone ahead and removed the super stockist from our distribution layer, as well as we have done some operational efficiency savings, which we've done in the last 2 years. So what would be those savings amounting to in terms of basis point? Would it be 150 basis point savings in operational efficiency? Hello?
We have migrated, we have migrated from a 3-tier distribution model to 2-tier distribution model, and we have eliminated one layer of super stockist. Now we are directly delivering it, the entire goods to the distributor. On account of this direct distribution, we could able to save almost 3 to 3.25% on the channel margin front.
Got it. And what kind of operational efficiency you would have accrued in the last 2 years?
So there are a lot of other things which we have done at our factory level and at a product level. For example, we have changed the recipe to reduce the oil content. That's one. We have resized our oil packets. So there was a saving on the packaging cost, and that has also positively impacted the cost of corrugated boxes, because we could also save the reduce the size of corrugated boxes, and that has also benefited us in the transportation cost, because with the smaller pack size we could able to transport more number of packets in the same truck. We have also reduced the number of labor in a few production processes by automizing the things. So these are few things as an example what we have implemented across all our operations and product levels.
So broadly, this should accrue, let's say, 15-20 crores of savings in the next 1 year.
So if you compare our gross margin for pre-COVID and now, so pre-COVID the oil price used to remain in the range of say 60 to 65 rupees per kg, and for FY22 if I take the full year, the average oil price was roughly around 122 rupees per kg. So it was 100% inflation in the oil price, and that in terms of impact on EBITDA margin, it was almost 10 percentage point. And if you compare our reported number, there was a very small decline in the gross margin or EBITDA level, that was roughly around 1.5%. So the entire 8.5% has been mitigated through various measures, including the direct distribution and other operational efficiencies, and some amount on account of reduction in the grammages. So that has flown in the financials so far. Still there is some scope. That's a continuous process which we always evaluate. But yeah, most of it has already been reflected in our bottom line. And that's the reason with the reversal in raw material pricing, even the raw material prices doesn't go to the previous level of, say, palm oil, previous level of 65 rupees. Even if it stays at 90 or 100 rupees, we are confident to get to double-digit EBITDA margin.
Got it. Just can you help me with the working capital differential in the direct model and through the super stockist earlier? What would the working capital difference that we would require over there?
Practically, there is no change in the working capital requirement if you simply migrate from a super stockist model to distributor model. There may be some negative impact slightly because distributors are relatively smaller in the nature, so they might seek some help from the company on the working capital front. But from May onwards, we have shifted to a zero credit policy. So now we are not offering any credit to the distributor. The credit is only for the transit time. So we have significantly reduced our receivable days in last 7-8 months.
Got it. And what will be the margin differential, let's say, in a small packet and a large packet? Because if I see our small packet is close to less than 90% of sales currently, and around 10 to 12% will be larger packets. So what will be the margin differential in both, and what kind of driver? Because that could be a large driver for us to drive margin, let's say, post FY24.
So initially there is no significant difference in the margin profile, because when you move to bigger pack, you need to offer more quantity to the consumer, because it has to be more economic for a consumer, which motivates him to buy the larger pack. So you have to offer more quantity to the consumer. However, there is a saving in the packaging cost and the logistic cost. So typically that gets offset. But as your bigger packs contribution increases, you can improve your realization over the period, and that's how you can have better margin in the bigger packs. But it's a journey; it takes a little bit time.
Got it. And can you explain me the PLI scheme which you all have got into, and you all have also accrued around 3.65 crores of PLI incentives in Q2, and probably for H1 it is around 7.9 crores. So how does this actually work? What kind of sales base are we taking into the picture, and which plant is part of the PLI scheme?
So based on the initial applications, the government of India has approved the PLI scheme to certain players. We are one of them. We got the approval under the PLI scheme. As per the scheme, we'll be getting the performance-linked incentive up to the period of FY27. And the PLI incentive is given on the incremental sales. So as per the scheme, FY19-20 is a base year, and they have kept the turnover of FY19-20 is a base year turnover, and whatever incremental turnover you get over the base year turnover, the entire incremental turnover is eligible for the PLI incentive. All the products are eligible as per the scheme, except potato chips. Potato chips is not eligible under the scheme. However, the entire Awadh sale is also eligible under the scheme. So for first 4 years, from FY22 to FY25, the rate of incentive is 7%. So 7% of the incremental revenue is entitled as an incentive. For FY25-26, the incentive percentage will come down to 6.75%. And the base year for FY25-26 will also be moved from FY20 to FY22. So for FY26, the base year would be FY22.
Got it.
And for FY27, the rate of incentive would be 6%. And the base year will be the FY23 revenue.
Got it. On the incremental sales, right?
On incremental sale, yes. And the base year is fixed. So every year, if you are growing, you can have higher incremental sale, and you may be entitled for the higher incentive amount. Now, there are two conditions attached to it. There has to be a minimum CAGR of 10% over the base year.
Mm-hmm.
And the benefit is also capped at 13% CAGR. So if you are growing more than 13%, your benefit will be capped at 13%.
Got it. So this 3.6 crores which we generated, let's say in this quarter. So for that, if I just reverse calculate as per 7%, 51 crores would be the incremental sales as on the base number, right?
Yeah, you may calculate because now you have all the details available.
So this base sales is the whole of company sales, or is some plant specific sales?
No, it is at a company level. So irrespective of any location, any plant, any product category, it is at company level.
Okay.
The only thing is that chips is not eligible under the scheme. So sale of potato chips is not considered for the benefit.
Got it. So what kind of incentives you all are, let's say, are guiding for FY23 and FY24?
So we're not guiding the exact amount, but yeah, over the period, we believe if we are able to grow at the current pace, definitely we should be able to get the benefit in the tune of 200 crore to 225 crore up to FY27.
Total incentives. Got it. And in this, where you move to, let's say, directly to distributor, are you having any freight savings? Because you would be directly moving all the products from the depot or from the from factory to probably the distributor warehouse.
Yeah, certainly there is a saving. So that 3% saving includes two elements. One is the super stockist margin, which we used to offer. We could able to save on the super stockist margin, and the another element is the secondary freight. The secondary freight is a freight cost from the super stockist go down to distributors go down. Now, since we are directly delivering it to the distributors go down, there is no cost of secondary freight.
Got it. So the ROCs which you're targeting about 20%, don't you think it's on the lower side, because let's say once we move to higher margins, where we had around 3-4% margins, around 10%, and where our margin goes to 10% EBITDA margins, so ROCs will be significantly higher, right? Because our ROCs, if you see, when the margins were around 6-7%, they were close to 15%, 15 to 16%. So don't you think the ROC will be significantly higher once our margins go higher by 400 basis points?
Certainly, there will be a positive movement in the ROC, and that will be definitely higher than the current level, because the incremental capex, as I mentioned in my earlier comment, with the plant capex, we can generate revenue of up to around 2,600 crore to 2,700 crore. So after this, the plant expansion, we don't think we will be required a significant expansion in the next 3 years' time. So our incremental capex would be lower, and with expansion in the bottom line, certainly we'll get to much better ROC going forward.
Because you broadly have 3 line of items where your margins are going higher. One is your distribution channel getting rationalized. The second is the PLI scheme where you would be doing broadly, let's say 15-16 crores a year. And the third item would be the operational efficiency, which you have gained in the last 2 years or so. So you probably have a lot of margin levels which are there to pull up your ROCs, I think.
Certainly. And parallelly, we are also working on the working capital management. As you can see, our receivables have reduced significantly. So similar kind of things we are also working upon inventory and payables.
Got it. Thank you so much. Best of luck, sir. Best of luck.
Thank you, sir.
Thank you.
Thank you. The next question is from the line of Sirish Pardesi from Centrum Broking. Please go ahead.
Hi, good evening, sir. Congrats for a good set of numbers. Just 2 clarification. I'm referring slide number 7, where you have given the split between the various sub-segments. So I just I'm more curious that what would be the gross margin? If the companies have average 28% gross margin, which are the segments are above 28% and which are lower?
Yeah, good evening, Shreeji. So gross margin, I can explain you in a relative manner. So in our case and generally for the industry, extruded has the best margin. Extruded, even in extruded category, the shaped extrusion has relatively better margin, followed by random extrusion, which is chewable in our case, and then pellet. Chips is also average. Namkeen would be slightly below average in our case because namkeen is relatively smaller category for us. On a standalone basis, namkeen is 11% to 12% for Prataap, and including Awadh on a console basis, that is around 16%.
Okay. No, I was more curious because last 2-3 odd years we have been talking to expand our sweet snacks, and that will definitely add some improvement in margin. But when I look at the number, it's still in the range of about 3-5%. So, I mean, I'm not going back to asking how the margin expansion will happen, but just wanted to understand, does it make sense to continue with a low margin product and not concentrate on the high margin product?
If you see 2 years of COVID, 2 categories have been badly impacted in our case. One is ring, another is sweet category, because these 2 categories are more focused towards small kids. So now we are expecting slightly better growth from sweet snacks. Even there was a severe raw material pressure on the sweet category as well. There are few key ingredients where we have experienced a severe spike in the raw material pricing, including the sunflower oil, whey protein.
Hello.
So at a current level, sweet margin is almost at par with rest of the categories. It's not very significantly different. But yeah, with the reversal in the raw material pricing, even for the sweet category, certainly it gives much higher margin than the snacks category.
No, I agree your point of view, but just one honest question. That last 3-4 years we have been talking to get the improvement, Now, at least I can see that the rural improvement is within the visibility and the sales momentum will pick up. With that, are you fairly confident that, I mean, you have been saying that double-digit margin, but why it should restrict to double-digit and highs of 15-16% is visible for next 3-4 years?
I think initially we have been at a very low margin for last 3-4 years, it's close to 6%. So definitely let us aspire for 10% first, get it to 10% for 1 or 2 years, and then definitely we can aspire for more. But getting consistent 10% double-digit margin for 1 to 3 years is more important as of now.
I got it.
To add on Amitji's answer, actually, the idea is to get at least 10% margin first, and then whatever we get more than 10%, we would like to invest for the top line growth by way of marketing and brand building, because in last 4 or 5 years, we've not spent anything on the brand building. Now it's a time to invest in the brand building with reversal, since we are also getting some benefit on the raw material pricing. So we are planning to invest some amount for brand and building, as Amitji has also mentioned in his previous comment, that 1 to 1.5% we intend to invest for the brand building. Sure. Having a brand ambassador on board and having some advertisement on the GECs.
Yeah, that was helpful, Amit. My second question is on the direct shipment. So we said that we save the PFA cost. So what percentage of revenue we get through the direct shipment?
Almost more than 80 to 90% revenue comes from direct shipment as of now.
Okay. 80 to 90%.
Yeah.
Yes.
And just last question, Amit, on the 23% growth, what would be the volume growth in Q2?
I think it's a largely volume growth, Shirish. Like around 2.5 to 3% could be the price growth, where the price realization has improved over the period because of direct distribution and some other reasons. But yeah, rest entire growth is the volume-led growth, where we have sold more number of packets.
Okay. Wonderful. Thank you, Amit, and all the best to you and the team.
Thank you.
Thank you. The next question is from the line of Keval Shah from GT Investments. Please go ahead.
Hello, sir. Thank you for the opportunity. Sir, first question is that with all the restructuring exercise that we have done with our products, does our value proposition still stay the same by sort of providing higher quantity than our competitors right now?
Yeah, to some extent, yes. Not to a great extent, because almost everyone has dropped a little bit there of weight. We have also done that. But definitely, if you talk about 1 or 2 top players, we give more weight to compare to them.
Okay, and that should still be how it used to be in the past right now, or would have sort of narrowed down?
Probably narrowed down a little bit, but that would definitely continue going forward also.
Okay. Okay. And that would be the case for the bigger size pack as well, right? Like 20 rupees, 30 rupees pack as well.
Yeah.
We have the same proposition there as well.
Yeah,
okay.
100%.
Okay. Got it. Second question was, sir, that our aspiration is to, not, I mean, I'm talking about 3 to 5 years down the line, is to take the small pack segment contribution down from roughly around maybe 85-90% right now to somewhere around 40 to 50%. So that replacement, you're expecting it to be done by a 10 rupees pack at the same time, or are you expecting the bigger size pack contributing more to the revenue over the period of time?
I think 40-50% number would be quite aggressive. We are targeting somewhere close to 75% in 2 to 3 years time, but probably 5 years time it might go down to 60%. And the major replacement will come from 10 rupees and 20 rupee packs of chips, and the other major change will come from the bigger packs of namkeen, that is the take-home purchase.
Okay. Okay. And with the 20 rupees pack and the bigger pack of namkeen, do they sort of contribute higher gross margin than the ones that you might be having right now? Just specifically these 2 segments?
I think they would have, going forward, they will definitely have much better margin.
So any rough range, if at all you can provide, for these
No,
for the
very
margins for
difficult.
these? Okay.
I think very difficult to right now. Very difficult.
Okay, no problems. And sir, you mentioned that we sort of, with full capacity utilization, we have a revenue potential of around 2,800 crores. So that includes the J&K facility as well.
Yes.
Okay.
It
So
inclusive of
that.
that.
Okay, so this is inclusive of all the capex that we are in process right now, and sort of considering everything, we should be potentially be reaching 2,800 crores on a full utilization, right?
Right.
Okay, and so, sir, the last question was, sir, are we targeting any new categories right now?
No new categories as of now.
Okay, all right.
We are anyway fairly diversified.
Sorry, sir?
Yeah, I was just saying we are fairly diversified and we are present in almost all the categories. Currently, the entire focus is on the distribution expansion. So we are deepening in the existing territories, and we are also targeting new geographies where we have little presence with the J&K facilities.
Okay. Got it, sir. All right. Thank you.
Thank you.
Thank you, sir.
The next question is from the line of Prolin from Goldfish. Please go ahead.
Yeah. Hi, sir. Thanks for taking my question. Just want to understand the impact of inflation a little bit better. In the past instances when, let's say, the raw material basket has come down, has the grammage been very sticky and that has not gone up? Is that how it works, or how soon we have to pass on this benefit to the end consumer based on the competitive intensity, and will it be any different this time around?
I think it has worked that way only. Once the grammages have been reduced, no one increases the grammages. But if there is a steep fall in raw material prices, there might be some extension or some extent in increase of the grammages. But I think we can assume that the weight will stay at the same level and the margin should improve.
Right. So let's say, for example, even if palm oil were to go back to the pre-COVID levels, we can expect the grammage to remain at a similar level, right? Is that correct?
No. From 140, 50 probably it goes to 60 rupees level, then definitely everyone will try to increase some weight.
Sure. Right. Understood. No, so the larger...
From here.
Fair. By the way, what is the Q3 run rate of palm oil? You mentioned 126 rupees, if I'm not wrong, for Q2 on an average, 126 to 128. What is the current run rate that we are working with?
It's difficult to share the average price for the current quarter. I can share you the prevailing range because still the fluctuation is very high in the palm oil pricing. It came down to 95 rupees, currently trending roughly around 103 rupees. And again, it varies location to location because of difference in the freight cost.
So if, let's say, ignore the 95, so if we assume it's at 105, so still that's a 15 to 20 rupees correction, right, on a sequential basis?
I'm not saying this is going to be the average price for this quarter.
Sure. All right, I take
price.
your point.
As I said, we always have some short-term contracts, so.
Okay, got your point. So the larger point that I wanted to make is that, this 5 rupees grammage is something which is very sticky, right? And what happened with the cola company sometime in 2005, 2006 was that everybody came together and decided, okay, we don't want to sell that 5 rupees, 10 rupees, 5 rupees kind of this thing, right? I mean, pack. So is that something, a possibility where, this whole trend of moving out, away from 5 rupees is slightly more faster than what you are guiding or what we are assuming? Can that happen in such an environment?
I think it will take one more COVID kind of cases from it has to go from 5 to 10 rupees.
Okay, I hope not. Okay, no, thanks a lot for that. And so slightly, coming back to this question, coming back to your point on this whole margin thing, right? So I see multiple revolts, to be very honest, right? One, you mentioned that grammage little bit is sticky, right? That inherently should bring in some margin improvement. We have done a lot of things, right, in terms of logistics and all that is bringing in 300 bips improvement. packaging things we have, we have changed. Then also PLI benefit. Then we are changing the mix as well, right? So I mean, are we slightly underguiding when it comes to the margin improvement, and do we want to take it first to 10%, and then is that a fair point where you can give a better guidance in terms of margin improvement? Because I see lots of levers, right? I mean, what am I missing in terms of the in terms of slightly higher improvement in margin trajectory for us?
You have covered almost everything as far as margin improvement is concerned.
Correct.
So, Prolin, actually, we are certainly aspiring for the higher margin, but at the same time, we want to invest for the brand building. So, as I mentioned earlier as well, we want to invest for brand building, and we are hoping to invest at least 1 to 1.5% to 2%. So, if we are able to get more margin than 10%, certainly we would like to invest. But yeah, aspirations are much higher, and we don't want to limit ourselves at 10% EBITDA margin.
Great.
That's measures what we have taken over the period that are going to continue, and certainly those will help us to improve even from 10% level.
Sure. And this last question on this whole movement away from 5 rupees, do we also have adequate products in our basket which will help us penetrate the 10 rupees or above 10 rupees kind of the counters, right? Or do we need some other products in our basket to probably gain more market share there? Or do you think our product basket is enough and we have enough products to cater to that 10 rupees and above grammage segment?
I think there's sufficient range and products available for 10 rupees, 20 rupees market to go into a B-class outlet. Mainly, I think it would come from potato chips and namkeen.
Understood. Okay. Great. Thanks a lot for this and all the best.
Thank you. Yeah.
Thank you. The next question is from the line of Kunal Patel from Equilegence Capital Advisors. Please go ahead.
Yeah, hi sir. Thanks for the opportunity again. Sir, one question is on Jammu facility. So can you please tell some more about the Jammu facility, what kind of investments we are doing there, what kind of benefits we will get from the state, and this obviously gets covered under the PLI. So if you can just talk more about it.
So I think the first on the investment, probably it will be close anywhere between 90 to 100 crores is the investment what we are targeting there. Secondly, it would be the biggest capacity after Indore. So it will have almost everything other than sweet snacks, because we don't need a sweet snacks plant because we already capacity is available in Indore. It will have potato chips, extruded snacks, pellet line, and full range of namkeens. So there are some benefits, state benefits also probably if you can highlight.
So in addition to PLI benefit, there are other schemes for J&K states, which is central government scheme, and where the company is eligible for additional incentive. And the eligible investment under that new J&K scheme is investment in the plant and machinery. So whatever you invest in plant and machinery, if you get the approval, subject to the approval certainly, you are entitled for 300%. The benefit equivalent to 300% of your investment in plant and machinery. So for example, if someone invests 50 crore in plant and machinery, the benefit would be available equal to 150 crore over the period of 10 years from the commencement of production. And every year, 10% benefit will be available. So if I continue with the same example, 50 crore investment, the total pool available is 150 crore. And that 150 crore is available over the period of 10 years, 15 crores every year. So that additional benefit is available for the Jammu facility.
Okay, and this will be in addition to the PLI benefit that we are getting?
Yeah, this is in addition to the PLI benefit. So company has to apply under the scheme, then there is an assessment process, and subject to that assessment, eligible companies will get the approval.
By when do you think this facility will be started with commercial production? If you get approval.
I think probably by end of Q2 next year.
Okay.
Q1, April, May,
June we are targeting.
We should be able to start.
Okay. Related question, because this will be the second largest facility for us, So safe to assume that Indore facility will now start addressing markets which are more south and west. Is it the safe assumption to make?
No, we are fairly decentralized in terms of the manufacturing facilities. South is anyway catered by our Hyderabad plant and Bangalore plant. We have a facility in Hyderabad for potato chips, and we have facility in Bangalore for extruded. Namkeen is supplied from here because anyway the logistic cost for namkeen is relatively very less. Indore is largely catering to western market and some part of northern market, because we have facilities in North India. We have one facility in Hisar for chips and extruded. We have another facility in Karnal for potato chips and pallet.
Right.
So J&K facility is essentially to cater to newer market like Punjab, Uttaranchal, Himachal, and Jammu and Kashmir. And certainly that will also be help us in developing the Hisar and some part of Haryana.
Mm-hmm.
But that is largely for the market which are currently under-penetrated.
Got it, sir. Sir, last question on the sweet snack side. Based out of Ahmedabad, I'm still waiting to see your products in the store near me. So, what's stopping you from sending those products over to a neighboring state in Gujarat? So what are the challenges there?
So for Gujarat, basically our main market is through Awadh only. So we are targeting now Awadh to basically distribute our sweet snacks in Gujarat market. Unfortunately, they are not that strong in Ahmedabad. They are very strong in Saurashtra area.
Correct.
Hopefully by next probably 1 year you will see Awadh product and sweet snacks across all complete Ahmedabad.
Okay, and it will be catered through the plant in Indore that we have.
Yeah, through the plant in Indore and through our distribution from Rajkot.
Oh, understood. Okay, thank you so much, sir, and all the best.
Yeah.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. As there are no further questions, I now hand the conference over to the management for closing comments. Over to you, sir.
Thank you all for joining us on this call today. Enjoy the rest of your evening and stay safe.
Thank you. Ladies and gentlemen, on behalf of Prataap Snacks Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.